and how much money under what structure do you actually seek as a very early stage business, right? So not sure which one of you wants to take this first. That's that kind of the first.
Those are a lot of questions.
Yeah.
I'm going to moderate a little bit, right? You can speak for 15 minutes now.
Go for the first one.
I don't remember what the first one was.
So my first thought was like, if you need to raise money, don't. No, do, but think about it in the sense like, you know, what do you have to prove? Like, think of it, if you're gonna raise from your parents, right? Like from your friends and parents. And when I thought about raising money, it was always, as a founder, it was always, I have to raise from people that I trust and that really matters to them. Like, what is the one thing that I need to prove so that their money doesn't go to waste? And so I think it's oftentimes when you raise from professionals, oftentimes this emotion detachment, but I really like stress the importance of raising not only for the investors and wanting to do the right thing by your investors, but also raising the most minimal amount that you need. Because the thing is, what you're trying to do is prove that your hypothesis at this current state is the right hypothesis, and you want the money to be able to prove that hypothesis, right? And don't try to raise for even more. You're not at that stage where you need to kind of scale that hypothesis because you know you have product market fit. You're trying to prove a hypothesis. So raise as little as you can is kind of my gut instinct out of the 5 questions that I...
That was the first one, yeah. So how do you typically structure that?
I think, how do you structure that? But I'll kind of answer it and follow on to what Tak was saying, is that when you raise money, okay, it's what I tell companies is that you should always be selling. Okay, it doesn't mean raising money, but that raising money is part of it. But you should always be selling your company, always be selling the story, selling the concept, selling the idea. Because what you want is you want to create that sense of urgency where investors are like, wow, I really want to be a part of this. Right? You don't want to be raising money when you need it because the timing never works out. So you want to get investors, you want to get people that are interested on a newsletter, you want to be updating them. Go out and meet people for coffee, always be pitching the story, always be pitching the idea. It doesn't mean you're raising money, it just means you're selling the idea, you're selling the concept, you're selling your branding, you're selling you as a founder. You want to build up that relationship, you want to build up all of the introductions so that 6 months, 9 months from now when you're actually raising money, you don't have to start from zero. You can actually start right where you left off with that person that you had a coffee with 2 months ago, right? It's like, let me update you, we're doing this. Remember I told you last time we're raising money? Well, now we're doing it. And then you can start from there instead of, let me start from square one, this is where we are, and then you have to build a bonding time in the relationship. The guy's like, who are you and what's your background? You can cut through all of that and you can get right to fundraising, right? So that's important, but going to Manuel's question about, well, how do you structure it? It's a bit different, at least for me, because my fund is called Brave Soldier Ventures, and we operate very differently where our investor base are all high net worth individuals, high net worth families, so we don't have institutional investors. So we can not deal with actually what I call all that nonsense, because I used to work for a larger fund where we had Hong Kong government money, we had Singapore government money, a lot of big name corporates, Docomo, Fujitsu, Sun Microsystems, Mitsui, at that time Hong Kong Telecom, Cable Wireless, which is BCCW, and having to sort of go through the song and dance of trying to balance all those funds and make sure that particular investment fit all of that criteria. I found it's a lot easier to deal with private banks that have high net worth individuals that want to invest in companies because the flexibility of being able to, and the speed in which to do investments, it's a lot faster. So that's how we do it, but we're probably the only fund in Hong Kong, dare I say, Asia, that not only gives you your round of funding, but we guarantee the next investor will come in and put the next round in. So it's almost like back to back, it's a 2-for-1. And the way we do that is we work with a larger fund whereby the investment criteria for them, that company is probably too early stage, so we'll be the one that goes in first, that makes sure the company hits those milestones, and then the next investor comes in. So you get 2 rounds of funding, which I think is a great, it's great for startup companies because they have to go from 1 round of funding to the next. So in terms of the structuring, Hong Kong has, I think, by definition, I think that, there are proper funds out here, like with Gobi or Mind Fund, but there are also a lot of funds out there that say they're venture capital funds, but they're not really. They're really mini private equity funds. It's like, does it make sense for them to piggyback a private equity deal on a smaller scale and let the large investors do all the due diligence and they just kind of ride on those coattails, or do they use their small fund and invest in a startup and take that higher risk? Well, I think for a lot of investors, they'd rather kind of do the other route. So we find it's more interesting to work with startup companies where we can actually put our own operational expertise in the company. So as a condition of our funding, the way we structure it is that we put our people within the company to work alongside the management teams. So we show up like employees, we're there in the morning, we leave at the end of the day, and we work alongside the founders. Because when I used to work in a larger fund, the mistake that I found was that these larger funds, they sit at a board level, right? At a board level, when problems happen, you're not problem solving, you're firefighting. Because by then the problem has festered so much, it's become so big, it's out of control, and that's when the board finds out. Because the founders, they have to manage downward to the team and say, don't worry, I got this, I'm taking care of everything, follow my lead. And at the same time, they have to manage upward to the board and say, look, you chose me for a reason, I'm going to take this company forward. But as problems happen, they don't tell the board, they don't want to see me comment, so they bury it and they try to fix it. And sometimes these problems are fixable, but when they're not, they just get bigger and bigger and bigger until it comes out, and then the board finds out, and then you've burned a lot of time. Right? So what we do is we like to put our people into the company to help on the operational side, and then we're able to problem solve along the way. So for us, our structuring is a bit different. As a condition of our funding, we want to have an operational role in the company. That way we can guarantee the next larger investor will come in the next round, because we'll make sure that that company hits those milestones that the large investor wants.